here with real estate entrepreneur Kasey Wong. What's your backstory?
Sure.
Where did it all begin?
My parents bought way back. This is when I was 14 years old. They bought a house, a triplex. My dad was doing the plumbing, the tiling, and all that. Now I was like mopping the floor, cleaning the grouts and all that stuff. I hated that. Fast forward, university. I'm gonna learn about finances and all that. I got into the finance business of the banks, and I was like, you know what? This is just not for me. I don't like it. So I borrowed the money. I bought a triplex.
For your dad's triplex. Kasey moves on with life, gets a university degree.
Yes.
We decided at that point, let's get a triplex again like dad.
Yeah, just like that. Just like that.
You left Toronto to go to the secondary markets. When did you kind of go up to the commercial?
It was more economies of scale. I was running around like crazy. It's hard to manage 10 properties all over the place, working yourself too thin, and you don't have the economies of scale. One place, one area makes so much more sense.
Welcome to The Hard Truth, here with real estate entrepreneur Kasey Wong. We are going to talk about the good, the bad, the ugly of investing in real estate, the decades of experience that Kasey has and brings to the table. And we're going to talk about things like mentorship, investing in different markets, and the highs and lows of being a long-term investor. So make sure to stick around and watch the whole episode. So, Kasey, tell us about your background. Why real estate? How'd you get into it? What's your backstory?
Sure.
Where did it all begin?
Okay, so my parents bought way back. This is when I was 14 years old. I was like, they paid me with Big Macs. It was like crazy. They bought a house, a triplex. I was a kid. They don't pay you cash, right? They pay you by like food, right?
So, meal the toy.
I know. So it was like, they bought a triplex downtown Toronto. It was near Greektown. I was like, okay, I don't want to do renovation. I don't want to deal with like, toilets and these, like, honestly, it was like tenants. It was like from Nightmare, right? And that's how my parents got started. It was at the height of the real estate boom in the late 80s. There was a crash in the 89s, but they bought this property. It was probably dirt cheap. But they sold it after 1 year, Kyle. They made like $90,000. I think they bought it for like 190. Was it 200 something, low twos, and they sold it for 97. I think $96,000 or $97,000 after just 1 year. So it went crazy. But my dad was doing the plumbing, the tiling, and all that. Now I was like mopping the floor, wiping the cleaning the grouts and all that stuff. I was like, I hated that. And then one tenant, I just told you before, is like one tenant was like naked or something like that, and then yelling at my dad. And like my dad's like, oh, like we're both, it's like probably about my age, right? Probably a little bit younger, and you see this old lady, like 60 years old, like half naked, right? And you're like, okay, that just turns everybody off, right? Out of this business. There's a lot of things that honestly, a lot of things that you don't think of until you get into this business. You just think about the building, right? You think about just the property, and you think about the rents and the financial aspect. But there's a lot of people, angry people sometimes, right? I get hate mails or whatever, but that just turned me off. So that was when I was young. And I didn't like it. I was like, no way. I'm financial. Like, you know what? I'm going to learn about finances and all that. So I went into I studied science at the beginning. I was like, I'm not going to be a doctor after my first year. I was like, oh, gee, I got to find something that I'm good at. So I went into business, right? Went into business and like business school at U of T and commerce is like, whatever. Honestly, you can learn a lot going through life, right? But this gives you a good foundation,
for sure,
right?
Yeah.
And then, fast forward, university, I got into the, sort of the quote unquote, the finance business of the banks and some consulting companies. And I was like, you know what, this is just not for me in a way that I don't like it. Sitting behind the desk, doing Excel spreadsheets for whatever, 8 hours a day, it wasn't for me. But then what is it that real estate, when did I start looking at it, is that, I looked at the financial aspect, fundamentals, right? There's nothing wrong with your RSPs, right? So when you're looking at investment, there's what the government wants you to do is that they want you to work for 40 years, right?
Yeah.
You graduate, let's say 25-ish, okay? Usually around 22, but let's say 25, okay? Round number. And you work to 65, that's 40 years, right? They want that. So you're thinking about, okay, you're paying taxes from 25 to 65, and then you turn into a RIF or annuity, and then now you pay taxes again. Crazy. You're constantly paying taxes. But in real estate, it doesn't take that long for you to create that cash flow, which is everybody's thinking. It's like, okay, well, your rent, your cash flow.
Yeah.
As simple as that. Is create that steady stream of cash flow, which is your rent minus your expenses. You get your, at the net, your cash flow. If you can create 2, 3, 4, 5, like at the beginning, I bought a triplex, right? And that's what we were trying to do, is that, okay, well, let's create this cash flow.
So after your dad's triplex,
Yeah, he sold it after.
your dad sold you. Kasey moves on with life, gets a university degree,
Yes.
gets the finance job
Yeah.
in Toronto.
Yeah.
And we decided at that point, let's get a triplex again, like dad.
Yeah, just like that. Just like that.
Okay.
A whole bunch of like problems again, right? It's like,
And just ask, was that an investment property, or were you gonna like house hack? Were you
I was gonna house hack.
okay? So
So-
before it was cool, before YouTube.
Yeah, before YouTube, I was gonna house hack. So 2002 is when we started analyzing properties. That back then it was my fiance, my girlfriend, fiance, then wife, right? But we were gonna house hack. I was like, she bought a condo. I was gonna buy this house. I didn't have the money, so I go, Dad, can you lend me 50,000? Right? As simple as, hey, Dad, don't give me the money, because my Chinese father, right? It's like, here's 50,000, son, right?
Right.
But no way I was gonna take that money. Right? I was like, what are you paying? You're paying 3. I'll pay you 4.
Right.
3% on a HELOC. I'll pay you 4%. You earn 1%, right? So it looks legit that I'm borrowing the money.
Yeah.
So I borrowed the money, paid that 1%, and it was dirt cheap, right? It was 197,500 downtown Toronto, Dundas and Broadview. Literally the size of the house, which is the lot, was 12 and a half feet. Okay, 12 and a half feet. You think about it, 12 and a half feet was a lot size. The building, there's no lawn or anything like that, right? When you walked in, because there's a foot, right? So that's 10 feet now, right? So give or take, you have a median wall. So that takes another maybe 6 inches. So you're looking at, let's say 9 and a half feet, maybe, I don't even say 10. I say 9.5 feet of living space, right?
Wow.
That's small.
Yeah, you can barely get a bed in that.
Yeah. When you say how, like, yes, it is. It's always throwing money at it, right? You know how it's like.
Yeah.
It's like, it just costs us money. So when the sewer line breaks of like the, let's talk about the bad stories, because it's fun, right? Like my contractor was there, but he's not a plumber, right? So I went to get an auger from Home Depot. And then he's not touching. He's like shaking his head like a little boy, right? I was like, oh, Barry, just stand aside. My dress pants, my dress shoes. I was like, you know what? If it splashes, close your mouth. Right? Just close your mouth. When it splashes back at you, just close your mouth, man. Right? So I'm like augering it out, right? I was like, okay, it just kept on collapsing and the things were floating out, right? You know what, when I say floating out, you know what it is,
Yeah.
right? So like, okay, toilet paper and like raw sewage, right? And so it's like, get it done, right? But in reality, it's just really throwing money at the problems. There's money. There's going to be, the sewer fix was, I think it was just less than $3,000, maybe 2,500-ish, right? Changing that sewer, backfilling and whatever, concrete, things like that. But when it comes down to it, you learn quite a bit when you start doing it, right?
And that's where that, I guess I would say some of your financial education and experience, where you weren't being stressed out by these problems. It was just an
Yeah.
expense, and the net income
Yeah.
justified it.
Yeah, yeah,
So
exactly.
it wasn't that you were upset about it or
Yeah.
not angry about it.
Yeah.
It's, well, this is a cost of doing business. I'm still proud. I'm in the black.
That's right. That's right. Exactly. So in the black, I mean, like this is 2003, and we're almost 2026 here. So my total rent was $2,455, right? And it was good because I think my mortgage is only $1,300 or $1,400.
And you were living there.
No, it wasn't.
Oh, not-
So we got married.
Okay, got it. Okay.
So I basically wrote, right before I got married, I wrote up the lease and everything for the last unit, rented everything out. That's cool, right?
Cool.
Bang, done. Like right before my,
Cash flow in Toronto.
yeah, cash flow in Toronto, 2003. But people have to look. It's like you look out, right? Like sometimes if it doesn't work in Toronto, you're looking outwards. And then we hit Hamilton. I'll hit Kitchener after, because I know you do. I do Kitchener-Waterloo, Cambridge, and you do too, right? But it hit Hamilton, hit Barrie, and it hit like those areas. But once you start analyzing, you know what's good and what's not. And I invested in Hamilton. I lost money in Hamilton, but like, you know what's doable, what's workable, right? Each one has. It's almost like each one has their own. They do have their own market, but everyone has their own finicky ways of doing things, in a way that Hamilton might be, higher taxes, property tax. The makeup of the tenant may not be as strong. That's how I saw it at that time in 2005 to 2007, where your demographic of tenant wasn't as strong as, let's say, the Kitchener-Waterloo, right? But you have to sift through them, right? And then I hit Barrie. Barrie didn't have a lot of multifamily. Barrie has a lot of single-family homes, We bought 4 single-family homes there, or townhouses. So you learn the makeup of each city, and then which one was working better. And you say, okay, now I'm gonna divest the ones that sort of don't fit my model. Your model will be different. My model is different from everybody's. And now my model would be the 2.5-story walk-up, 1960s and 70s built, and that's a vintage. And because the build, when people were building these multifamily in 1960s and 70s, they built because there's a demand there, right? In the 1980s, there's a housing boom, so they built a lot of houses, right? And even in here, they didn't build here as much, right? But they built in Toronto, and then to pick up the slack of the tenants, there's condos being built afterwards in the 1990s, 2000s, a whole bunch of condos. There's no purpose built, right? And now it seems like to pick up the slack of the tenant profile or the investment style right now, it's more small and multifamily. People are getting to that, right? And the downfall of the condos, right now it's more stagnant of the condos, right? So you see that in Toronto. And Kitchener-Waterloo, tell me, Kyle, is it really overbuilt?
I would say no. I mean,
Exactly.
We had one of our commercial finance experts on earlier today, and he talked about how the vacancy rate's at up to 4%.
Yeah.
That's still a healthy vacancy. That's a healthy. That's not a bad vacancy rate.
That's right.
So that to me tells me we're not overbuilt at all.
So are there a lot of empty condos in Kitchener-Waterloo, Cambridge?
There are empty condos, for the most part, from people who aren't in touch with the price.
That's right.
So they're looking at their cost and trying to price the rent based on that. But you need to be priced right. A condo in Kitchener, Cambridge, if you're levered at 80%, it's negative cash flow.
How many condos are built in Kitchener-Waterloo, Cambridge, and Waterloo?
I don't know the number off the top.
Oh, no, but when you drive down,
Oh, yeah.
There's not a lot.
No.
Yeah. In downtown Toronto or in Toronto, there's a huge amounts of condos being built, and there's a lot of vacancies. So what this tells you is that the primary market will be saturated with developers, right? They will build, they will overbuild, right? In a good times, they'll overbuild. So just be careful. When there's a good time, step back, relax. What's happening here? Kitchener-Waterloo, Cambridge, developers don't usually go there because the price point's doesn't push it high enough. They're not going to make enough money. So they have to be risk adverse. They're not going to overbuild, but they do build, mind you. They will build, but they're not going to overbuild and saturate the market. And when that happens, it hurts the old builds, right? The 1960s and 70s and maybe 80s built, right? So just be mindful of, hey, wherever you guys are investing. I know people reached out. They're in Vancouver, they're in Ottawa, they're in the States. Your primary market will have higher risk, right? In a way that if it has a downfall, you're going to hurt first. Secondary market, not as bad because they're not going to overbuild. But your secondary market has good workforce. Okay, so if you're looking at KWC area, the Hamiltons, the Barries, where I had invested in, look for good prospects of employers, right? That's what you do as well. What's happening with people don't even know Google was here for over 20 years, I believe. Right?
For a long time.
A long time, right? Google's been here for a long time. You have Communitech, you have all these tech companies here, incubators, and people don't even realize.
Well, and BlackBerry is not what it was in 2009, but it's still a big company.
That's right.
And I like to always talk about that in Kitchener-Waterloo. That was probably the best thing that could have happened when they scaled down, because it spread the talent.
Yes.
It spread the talent across the town. So
yeah.
I want to, when you're talking about, you left Toronto to go to the secondary markets. Did you go buy more? You bought some single families in Hamilton and Barrie. When did you kind of go up to the commercial, and what caused you to go up to the commercial residential?
Yeah.
So residential properties, but 6 units or greater commercial.
Yeah. It was more economies of scale. I was running around like crazy, right? And it was in Hamilton, or you had Barrie and had London, and it was spreading myself way too thin. And I couldn't grasp how am I going to work doing all this stuff, right? And everything, I never could work with one good contractor, right? I found one, but they wouldn't go that far. They won't go to London. if they're in KWC, all the business kid, why would I, whatever, drive an extra hour to help Kasey? No, they're not going to do that. So each one, so when you're saying, when did I find out, is that I was too thin, right? Working yourself too thin and you don't have the economies of scale. But if you have everything all over the place, know what you can do to scale your business in a way that makes sense. We're thinking about refinancing because I never wanted to sell my properties. So refinancing, you couldn't draw enough money out because the rents weren't strong enough, right? So we're working with some mentees and saying that some of these mentees go, oh, I don't have enough money, right? I'm like, let's really dive into what you have and let's see what you're capable of buying, right? I didn't think we had enough, right? So instead of refi, I sold. And when I sold, I upgraded to like units wise. You buy more units. And that made sense. So you just have to work things out properly in a way that it's a time to sell. There's a time to upgrade. There's a time to pay the capital gains and make your business more streamlined, right? It's hard to manage 10 properties all over the place, or 10 single family homes with tenants and all these roofs or all these problems. Like one place, one area makes so much more sense. And it doesn't take that long to stabilize a building, right? It doesn't. 3 years, maybe 4 years, 5 years for sure, right? You get that tenant turnover. Some people leave. Some people die. It happens, right? You're in this property management business, right? I had several tenants that passed away, right? There's another story we can hit upon, right?
We'll hit that one later. I want to, so when you talk about, when you just made it so easy to say, I'm in Toronto, I just started investing in these other markets, and then I recognize the scale. In 2017 and 18, I was doing consulting for a major real estate education company, and we would do workshops in Toronto. And we would do these little breakout sessions, right? Yeah. 10 investors around me. And they would be like, where do you invest? I'd be like, Kitchener. And they would be like, What? Like, who? People rent in Kitchener?
Yeah.
And I was like, what? I was like, Google's in Kitchener, like University of Waterloo, Laurier, like Major in Sun Life, Manulife. And it was just wild. But like, I literally, once I realized that this was the reaction, I used to make a joke, like, there's not a big cliff in Milton, right? There is actually a cliff in Milton.
Yeah.
Like, there's a whole city
Yeah.
beyond that, and they didn't believe it. They didn't know it. So you were really ahead of your time to recognize that there was these opportunities. So where do you focus now? Where?
It's the same place, Kitchener-Waterloo, Cambridge. So I bought a 10-plex in 2004. It was $430,000, and it was right beside. It's on Chapel Street. It's beside the courthouse. Okay. Literally, like when we first walked in, I was like, there's some problems with that property as well. I'll touch upon that because people want to know. When I walked that building, $430,000. That's $43,000 per unit. Okay. We didn't have the funds, so we did have money. We had some down payment. But then we did a vendor take back, and it wasn't even heard of back then. So what I did was we did a VTB. I think it was 20%. Okay, 15 or 20%. I believe it was 20% of the 430. Okay, it was like some crazy number that we asked, and we asked the interest will be. I think it was like interest only for about 3 or 4 years, and we matched it with the first mortgage. And it was, it was like, wow, we bought this for 430. Back then it was expensive because we bought Toronto in 2003. It was a triplex for $197,500. It was like 430 for a 10-plex, but it seemed expensive even at that time, right? It's always going to be expensive at that time. Okay, until you can stabilizing and hold it for the 10 years. Then you realize, oh shoot, I should have bought two of them, or I should have bought 3 of them. Mind you, I should have known back then is that those unit sizes were small. Right. There was 8 one bedrooms and 2 bedrooms. And when I sold it, or when I was even managing it, I was like, oh, you know what? Yeah, the issue is this. They were small units. And it was difficult to rent because of that. So you had to find a specific tenant profile, like single people, right? Or, people on a work term or something, right? That doesn't want, a big family, because that's what you're catering towards now. Yes, it's walking distance to the court, like downtown Kitchener, but I should have bought if I could have, two bedrooms, good size, and maybe a little bit further away, right? But that's my mistake, right? Because I didn't know better, right? Because I thought 430,000 for a 10-plex was a good price, and it looked right, the numbers. The average rental was about $700. 700 times 10, 7,000, right? Per month.
Almost a 2%er.
Yeah. So it's pretty darn good. Yes, a 2%er. So you snap your finger and go, okay, well, that's about 2%. That's over the 1% rule. I would buy it, right? So you look at the numbers, it made sense, right? Eventually your mortgage goes down, right? Your rents are inching upwards. So that's a good way of looking at it over the long term. But there was some negative aspects to it. Negative aspects, the units are small, older building, no insulation, heating costs was high, plumbing, there's some plumbing issues, had to change the pipes because eventually you get pinhole leaks. There's things that in hindsight, you say, okay, well, this is what I'll look for, to avoid, right?
Right.
So yes, I was ahead of the time where people weren't looking at Kitchener-Waterloo, Cambridge. But we talked about this before, is that people will see where they live as something good, right? A whole bunch of you people in KWC don't see how prosperous this place is, all right? Which is good for investors in Toronto, like looking at, wow, KWC is darn good, right? Other places are different in a way that they have their setbacks, and they have their positive as well. I just see a little bit more positive to the KWC because number one is jobs. Companies that brings jobs, that brings people. When people live there, when people have jobs there, they have to live there.
Yeah.
Right? And is it far from Toronto? 1 hour. It's not that bad, right? If you want to, pay for 407. So it's very doable for people to take a look at the secondary market.
Oh, just to add in the shameless plug for KWC here, it's not even just jobs, it's the diversification of the job market.
Yes.
We're tech, we're insurance.
Yeah.
We don't even talk about our manufacturing, but in most cities,
it's strong.
Our manufacturing would be a standalone good enough, but we just have the university and the tech, which is more sexy.
That's right.
But we have everything.
Yeah.
And all of them are.
Talk about the manufacturer. I know you want to talk about it.
Yeah.
It's Toyota's here, Linamar's here. You have this Mazak that does manufacturing of machinery. You have almost like the financial services. So you have the Sun Life, the Manulife is here.
Yeah, both like global head offices are here. Yeah.
Right? You have a spin-off of really smart students that come out of the Waterloo and now business schools in Laurier. So you have a spin-off of, okay, well, these companies are here. They're going to grab these students that's graduating. When you have a downturn in the economy, people tend to go to the university, right, and upgrade their skills. So you have the university built there, and then now you have high-tech jobs, both high-tech as well as manufacturing. But people don't realize that Cambridge is more manufacturing, right? Yep. Well, Kitchener, quasi, I like to say, it's more tech. That's how I see it. On the outside looking in, Waterloo is more university, more education. So you have these three different types of cities working together, right? And then you have different price points. I like to say Waterloo is higher, then it's Kitchener, then it's Cambridge-ish, right?
Yep.
Like Kitchener, they'll kind of overlap, right, each other.
Yep.
But when you look at it, damn, this is really good because they have all these diverse industries. And now when you look at, that's a problem with some other cities, is that they're really heavily built on, let's say, automotive. Nothing wrong with that. But when you have a downturn and like some crazy lunatic, maybe in the south, right, say, I'm gonna slap some tariffs on whatever, and then bang, your industry really suffers. People start to move out because of that, right? But that's you have to look at fundamentals. Like, take a look at fundamentals first. What causes people to move? What causes people, what really lifts a city? It's really companies and jobs.
Well, I think I talked about it earlier with BlackBerry. When BlackBerry went down in 2000, when BlackBerry had their big stock crash,
Yeah.
everyone's like, "Oh, Waterloo is doomed."
Yes.
It was the best thing that could happen to this town.
Yeah.
And this is I was younger at the time. I was in my late teens, early 20s when this all happened. So this is all what I've been told. But all the people who had the 200K cushy BlackBerry jobs took 80K jobs with stock options at startups.
Yeah.
So the talent took less based on upside, and all these startups, all this talent got spread out, and they weren't making the crazy salary anymore, but they were motivated into these companies.
Yeah.
And we've got little companies around town like Desire to Learn and Shopify, and that have all blossomed from this tech hub that's been created here.
Yeah.
So
that's what I find is that people just don't look behind the headlines, right? Honestly, the Toronto, like when they said, "Oh, BlackBerry's like going out," that was probably RIM back then. I was like, "Oh my goodness, RIM is going bankrupt," right? Everybody in Toronto goes, "Oh my goodness, like Waterloo is dead," right? And the thing is that people don't know, right? In Toronto or whatever, people don't realize that, hey, there's another there's companies that's flourishing. There's a lot of students that's being educated here. So there's the high tech, sort of the MIT of the North here. And people don't realize that. But the thing is that now you as a long-term investor, okay, you just have to look at the fundamentals. Like right now, what we're sitting in right now is that people are scared, right? As in they're not investing, right? Or they're on the sidelines. Interest rates, are sort of flatlined, right? And developers that stop building in Toronto, right? Now your rents are coming down, which usually there's never going to be a perfect time, right, Kyle? There's never going to be a perfect time of, okay, well, I have low price, high rent, low interest rates. Would you ever get everything lined up perfectly? No, right? It never happens that way. So my suggestion is that, forget all this bad news, all this news about everything. You can't control any of that. You can only control what you have right now. So buy smart, analyze properly, and just hold for 5 years, right?
It's the conveying message that keeps being shared from people who come on, the people who are still standing, the people who are still investing. Nobody's talking about short term. Yeah. Everybody's talking about long term and a long-term investor and a long-term vision. And I think the other thing that you mentioned there that it's really important as well is buy opportunities don't feel good.
Yeah.
A good buy opportunity isn't like everyone's like, "Hey, you should do this." That's not a good buy opportunity. A good buy opportunity is when it doesn't feel good.
Yeah.
And that's right now. It doesn't, we're looking around, we're like, this feels good because we understand. But that retail investor's looking around and be like, well, everyone says don't do it.
Yeah.
And you probably should.
Exactly. So this downturn in the market will only last a couple of years. Okay. So we're 2026 right now. In 2 years, in 2028, it's going to come up back up. Okay. So usually when you take a look at this downturn, so 2025, 2026, like we're going to have a flat line or whatever. In just 2 years from now, you'll see the sentiment's going to be completely changed. Okay. In just 2 years time, maybe 3, but I say between 2 and 3 years, it's going to start picking up and it'll be really, really good. People are very short-sighted, right? And people can only see this nightmare or whatever is happening now, and they can't get past it. They only buy when everything is going up, right? Oh my goodness, like, okay, I'm going to jump on the ship again. It's like, it started moving, right? So it was docked, right? So we're in a sediment of, the prices are stagnant right now. This is the time to, number one is get your education up, as in know where to invest in, right? This is the time to analyze. So you have to do your homework. Like when I bought my triplex in 2003, we started analyzing 2002. We started, taking a look at condos and, walking through properties and doing all that for 1 year, right? And then you buy. So, hopefully people can just see this clip in 2028-ish, okay? We're 2026 at the end of 2025 right now. We'll just wait until a couple years. Take a look at this clip in 2028 and say, okay, well, is Kasey right or wrong? 2028, how is it? How's the market compared to 20? Because right now, let's say it's crap now. Okay.
Yep.
So nobody's eating, right? Agents are like starving, or mortgage brokers are hungry, right? But you have to look in the tough markets because the opportunities are here. There's still 1%, like they have the quote unquote like a close to 1%, even better when the turnover happens, right? So there's markets right now. I took a look at a 12-plex for just over 2 million, right? So there's deals out there. They could be asking, let's say a 10-plex at 2.5, that's 250,000, right? Mm-hmm. Offer them a 2.2, 2.1, right? There's nothing wrong with that. You can offer that.
Yeah.
Right? If the rents are not strong, if the rents are weak right now, it's actually better for you, right? Because you're buying at a depressed price because the rents are low.
Yeah.
Right? So I find that a lot of people, the sentiment is bad, and people sort of go in hibernation and just stick with what they want. But don't complain after 2 or 3 years and say, my financial situation hasn't changed, because you haven't done anything. Do you know what I'm saying? You're complaining that your situation hasn't changed, but you haven't done anything to change it, right? And I have friends that, they've been working there for 20, 30 years at the same job, right? Some type of back office financial company, and they're bitching. It's like, oh, I hate this job or whatever, right? Dude, you haven't done anything, man.
They're going to buy next year, though.
Oh, yeah, next year. Oh, yeah, just wait. Yeah. So people are like that. Like, people bitch about everything, right? But dude, you haven't done anything, man.
What are you doing right now? What are you buying? Are you selling? Are you all both?
So we're looking at buying right now. We're looking at buying the same 2.5-story walk up.
Yeah.
At good prices. Usually at the 1% rule. Okay. Yeah. But right now, yeah, it's hard to find that 1%. Okay. But there are deals out there. So right now, we're looking at those 10 to 30 unit buildings. Okay, and those are the buildings that's built 1967. You know this, Kyle, mm-hmm. right? KWC has a whole bunch of those. Those are the best properties in a way that I'm not telling you guys to hold it for, like, because people are saying I'm going to hold it for life, right? No, dude, you're not doing that. You hold it for 5 or maybe 10 years and you upgrade. This building was built in the 1960s and 70s, and we're 2026 now. It's going to be up for another. It'll stand out for another 20, 30, 40 years. You hold it for 5 years or 10 years, get that growth, okay? Drive up the rents in a way that there's turnover, market rent, right? I don't mean like drive, like whatever, kick people out. No, I'm not. Just normal market turnover, yeah. Right? Do regular renovations. Don't over renovate. I've said that before, right? Don't over renovate. So what this means is that you're not putting like gold plated this or silver plated that. You're seeing what the market is. The neighbors are, what your competition is doing. Then you hold it for 5 or 10 years, and then you assess, right? And then when you assess, you analyze, okay, well, financially, inner, like self, as in, what can I do? My portfolio of buildings, what can I do now? I have, 2 10-plexes, right? Can I upgrade to a 40? I have a triplex, a 5-unit, and an 8-unit. How do I gather that extra capital, which you need, right? Because that's when I'm helping some of these mentees. I'm like, they're saying, oh, I don't have this money. I'm holding these properties. But sometimes you have to structure in a way that you may have to sell, you may have to refinance, draw that money out. And then that's what we did as well, is that you divested, a whole bunch of singles to buy something bigger.
I say this all the time. I'm a buy and hold investor.
Yep.
But everything's for sale.
That's right. That's good. Yeah.
The strategy is buy and hold. But that doesn't mean you only buy and hold that property. Yep. If you can take that equity and move it into a better performing asset, you have to do that as a prudent steward of your capital.
Yeah.
And people mix up buy and hold means you just buy and hold.
Yeah.
Well, yes, you hold the property until it's performing at the low end of your portfolio. When you move that equity to your high end.
That's right.
You identified this right away. I call it sell the dog.
Sell the what?
Sell the dog.
Sell the dog, yeah.
If you have 10 properties on your spreadsheet, what is the bottom performing one? And I always tell people all the time, it's probably your condo at Yonge and Eglinton that you love so much.
That's right.
That's the dog. One of the best location is the negative cash flow.
Yeah.
So look at the bottom performer, look at the equity, sell it, move that equity to the new top performer.
That's a good point. Okay, so Kyle, let's touch upon that. It's like, okay, you have this young and egg, okay? Like some people will buy it, they lived in it for 2, 3, 4 years and they start renting it out. Now you paid it off. That's a $800,000 condo that you're renting for $2,800. Okay, on a scale of rent for $800,000 on the return basis, it's very low because they're not even there's no leverage.
But it's crazy. It's young and Eglinton.
I know. Oh, it's young and egg, young and like young and eligible. That's what they used to say, young and egg, right? So it's like, yo, dude, that's the lowest performing because you're not leveraging, right? So you're renting for let's say just shy of $3,000, it's worth $800,000. So that if you do the rental over the amount of equity, okay, let's say you have maybe a little mortgage, or it doesn't really matter. When I say shy of 3,000 over 800,000, okay, your return is very small. Okay, so exactly what you said, Kyle. You're selling the dog because that is a dog. When Kyle says that, bang, that makes sense because people don't look at the leverage potential. They don't take a look at the return, okay? Bottom line return. So Kyle does. He takes a look at that and says, okay, you know what? What am I going to do with this 800,000? You can buy a 15-plex, right? Bang, you're leveraging, you make 15 units at 2,000, or let's say, 2,000, that's $30,000, right? 30,000, you say it's a 15-plex and you buy it at 220,000 per unit, that's what? 3.6 million, right? If my math
Yep,
ish.
I think so.
Okay.
You're close enough.
Okay. So you can see that really quickly. We're just doing math in the head right away, is that you can see that, okay, well, that 15-plex makes more sense than a young and egg condo. Makes sense? So Kyle is saying that sell the dog to make the next investment a star. So you're always upgrading. You sell your dogs, bang, you're investing. And then you keep on investing. So you have this time frame of the 5 years, and then you're selling out the dogs because they're not performing well on a leverage potential and overall market condition.
And the portfolio is still buy and hold properties.
That's right.
And then people are just illiterate. Let's buy and hold. I don't sell.
Yeah.
So the portfolio is
a buy and hold.
talking about your single family rental. Okay. But when you start talking about managing a portfolio, you have to be critical. You have to look at these things.
Yeah.
And it becomes non-emotional. It's just that one's at the bottom. It's not performing. I got to move it up.
Yeah.
That's just the nature of it. So love it.
Yeah. So there's a lot of things that we know that we don't know what you guys want to know, right? As simple as market conditions, like Kyle's talking about KWC. I had sort of the experience, probably a little bit older than you. I invested everywhere, right? So on a top-down basis is that you're looking at location, right? What's the best location for you? What type of asset class are you looking at? Or are you looking at condos, single-family homes? You're changing it from a bungalow to like a 4-plex now or 5-plex. Are you buying a 5-plex, a purpose-built 6-plex, right? These are so many aspects of talk that you have to know, right? That you have to investigate. So when he's talking about very simple as portfolio, that's very, very strategic down here in your whole portfolio of selling dogs. There's a lot of other aspects that you have to work on.
Yeah.
Right? So know what you're going into. There's a lot of top-down approach of taking a look at, again, from geographic location. It could be, whatever on the in Vancouver to on the East End to in the South. People are investing in the States now, right? I did that as well. That's another topic that we can talk about. But then you have to fundamentally go down to your portfolio analysis. And I think Kyle talks about that as well in a way that a lot of people don't realize that after about 5 years, take a look. If you stabilize the building, how much longer are you going to hold this for, right? And then start talking about different aspects of investing.
Because you do realize when you hold a property, after you've done a renovation, there's a bit of a yield curve on that property that you have to start injecting new capital into to keep it up to speed. So I want to be cognizant of time here. There's two things I want to talk about. Very briefly, unless you want to go longer on it, you invest in the U.S.
Yeah.
How'd that go?
Terrible.
Terrible.
I was, again, way ahead of the curve, right? It was in 2000 and 7, and I couldn't raise enough money. It was in Texas. It was 152 unit building. Look, Texas is great, and I find that people now they're looking at the states. I was looking at the states, and I think it was dirt cheap. It was like 30,000 per unit, 32 or 28, or no more than 40,000 per unit. Okay, for 52 unit building, 2.5 story. No, not even 2.5 story. There had no basements, so 2-story walk-ups. All right, it was ranch style in a way that it was like big and long, and some of these ones will have swimming pools. I just couldn't raise that capital to close this deal. And then we just walked away. I had to lose my deposit, walked away. But then afterwards, there was like a huge flood that sort of flooded, I think it was Texas and that area as well.
And this was in 2007.
Yeah, it was 2007.
Losing that deposit was probably the best thing that could happen.
Yeah. But the thing is that there's assurance, okay? Right. So don't ever be afraid. Okay, yes,
I more mean the market conditions that.
Oh, yeah.
2008 and everything in the U.S.
Yeah. So, yeah, it could have been good. It could have been bad. I just don't know because I sort of walked away. I didn't look back at it again. But, yes, there's always insurance, okay? So let's say there's a flood or the fire. If your building burned down, nobody got hurt, the insurance will actually pay you everything. That's what my dad said.
Right.
I was like, oh, my goodness, what happens if there's a fire, right? I go, if everything is good and nobody got hurt, it's like, that's pretty darn good because insurance will pay for your build, to pay for all the rent, to pay the mortgage, and you have a new building.
Right.
Do you know what I'm saying? Like, we know that. It's not a bad, quote unquote, bad thing.
Make sure you have the right insurance policy.
Yeah, make sure you have the right insurance policy. But when it comes down to it, like I looked at the U.S. market, I try to do it. But see, people are earning money there. I don't necessarily think that people look at the backyards first, as in, take a look at Ontario. It's performing really well in a way that people want to go south and say that, okay, well, landlord friendly. Okay, that's what they're always saying. They're pushing for that. When they say landlord friendly, what this means is that it's a capital state or capital market, right? So what this means is that they can build fast, right? And Texas is like that. There's so much land that if my rent started inching any higher, boom, somebody's building.
Right.
And then your rents are coming down again.
Right.
Somebody's building here, there. And then your market, you always have to be on top of your market, as in you always have to renovate. Right? People will leave if you don't have a nice product. In Ontario, it's like people are not leaving. Like, there's nothing.
Interesting to talk about that other side of things.
Yeah, the other side is that people don't leave Ontario because like there's not enough supply. Right? On the low, I'm not talking about the high-end condo. I'm talking about the mid-tier. People are not building mid-tier, like these things for $220,000. The new builds are still $350,000, $400,000. Right? We're buying it at market. We are buying it the market at $220,000 to maybe $240,000, and your rents are about $2,000. Or inching upwards, or you can buy it a little bit lower.
Yep.
Right?
Love it. I want to talk, we're going to get into the hard truths, but you recently started doing mentorship.
Yeah.
And you talked a little bit offline. You know, why now? Why are you doing mentorship now? Why?
Okay. So I'm going to pull you into this mentorship as well. Is that, okay, there's always people asking for mentorship on and off. And Kyle and I, we don't know honestly, I don't know what the heck I'm doing in social media. Like, you see my posts, I don't know, like, mine looks so, like, what is it? My kids are saying that it's so low end. It's like, nothing's polished, right? I'm like, yeah, but that's me. I was like, after I drop you off at school, I'm making a video. Like, it took me literally like 2 minutes, right? So, talking about mentorship, people always ask, oh, Kasey, can you mentor me? But it's on and off. It's like, here's after 1 month or maybe 2 months or the 5 months mentorship. And it's like, okay, so I never really scaled. I never really done it, right? In a scale that, you know, people can do it properly. And now when I ask people, mentors out there, and there's a lot of crappy mentors out there that they don't have like the expertise. Like, Kyle, you've been in this business how long?
Over a decade.
Over a decade.
13 years.
I heard some mentors like 2 years, and they have like a couple properties, and they're mentoring, and people are paying them $20,000-$30,000 for it. I only charge 12, but I'm gonna have to up it to like 20 or 30, I guess.
Yeah. You need to charge more.
Yeah, I can charge more.
Yeah,
right?
You're worth it. You've got decades of experience.
But I want to go to the site with people and say, okay, well, let's take a look at, because that's part of due diligence. When you do a due diligence, there's a financial aspect and there's a paper due diligence. You look at it, you know, oh, yeah, it looks good, right? Oh, let's go buy it. No, you got to actually go and touch it and feel it, right? Like a loaf of bread, right? It's like, okay, well, it looks good from this flyer. You're not going to go buy it, right? It's like, okay, it's 10 days old, right? But you're going to go there, walk in. It's like, okay, well, you know, the roof is done, boiler shot, so on and so forth. That's why the price is the price. It's so low. But you have, as a mentor, you actually have to know you have to know something. Like you have to go there with your mentees. And I find that people are getting they're just getting taken for a ride for like from these mentors. So Colin, like we know this. It's like, wow, it's like you're a mentor and you're charging 30,000. Like, gee, that's crazy. You must be like, this person must really want to get a mentor and not do their due diligence on the mentor, right?
Yeah.
So like you're a mentor, right?
I just started. We just launched the Inner Circle. Same thing. For years, people have been asking me,
yeah,
can you coach me? Can you mentor? So we're building that out. And for me, it's like, you know, I've always helped people, but as my business grows and my investment responsibility, I have to monetize my time.
Yeah.
Can't do it for free.
Yeah.
But like, I genuinely just want to help people. So I built the business to helping them, and we're learning about that business as we build it. I know lots about real estate, but I've never built a coaching business. Yeah.
So I think people should comment on something like, how should we run this business in a way that I do high end? Like you're going to do some high value mentorships, like really good mentorship, right? And then we're doing some Inner Circle or something. Like we're not partnered yet. Okay. Or I don't know what we're going to do, right? When we grow up, we don't know what we're going to do in this mentorship business, but I'm looking for help as well. Like people reach out, but it's very sporadic, right? So I don't know where this is going to take us. It might take us nowhere, or it might be a flourishing like mentorship business, right? But you know, it's like, it's always good to have people, you know, shoot things off of each other and say, hey, let's do something together, right? Because when you have like a lot of people we have people with experience, right? Like we have good experience, but we don't know how to monetize it in a way that, because I can't go to like everybody and just help them 20 minutes here, half an hour. I can't do that. So let's group everybody together, because that's the best way to learn.
Yep.
Right.
I love it. So I think that dovetails nicely to your hard truth.
Yeah.
So there's we want two. So we kind of classify it as newbie, brand new, buying their first properties, and more seasoned, so 5+ property.
Yeah.
What is the hard truth for a newbie? What is a hard truth for a more seasoned investor?
It's number one for the hard truth for the newbie is buying the right property. Okay. When we were analyzing it, it was hard in a way that we don't know what we were doing. 2003, there's no social media or anything like that. And plus there's so many mistakes that you can fall into. So I find that the newbie, the hard truth is that, there's so many aspects of losing money, right? Because you're not diversifying. It's not the RSPs.
Right.
It's not the mutual fund. You buy like a basket of 200 stocks, right? Index fund. You bought one property.
Right.
If you screw up, that's one major problem. Okay. So the newbie is this. You have to analyze it properly so you don't lose your shirt. Okay.
Love that.
That's newbie. For your seasoned investor is how to scale, right, properly, how to write your contracts out so you don't fall into the pitfalls, all right? So that's a little bit different in a way that, are you scaling out properly? Are you building it out properly? I know we stopped this REIT program, but we're going to do a REIT. We spoke to a few people that actually had REITs, and they said, no, I'll never do it again. Wow. Because the money there is, you earn so little. Right. Own your own property.
Right.
Okay? There's nothing wrong with owning straight out and then, you know, snowballing it. Okay? But you actually have to be steered properly and make these contracts with people ironclad. Okay? I find that a lot of people I have to say, some people don't take mentorship because, it's cost a lot. It's 20 or 30,000, right? Potentially you can lose a lot more.
The double-edged sword of leverage is you didn't put $100,000 down a property. You put $100,000 down, but you're playing with 500.
That's right.
You put 500 down, you're playing with 2.5.
Yeah.
So when people start weighing the cost of mentorship, support, coaching, consulting, whatever that is, against the actual value. The leverage is two-sided. So you make mistakes at 2.5 million.
Yeah.
20
costly.
grand is easy. I know personally, I've spent hundreds of thousands, probably a couple $100,000 in mentorship, coaching, training, education. Like, and people are like, "Oh, you paid that to people? You paid that to a program?" Like, you paid 80 grand for university and you didn't bat an eye.
Yeah.
So me paying professional business people to teach me what they know about business? Why is that a problem?
Yeah.
I didn't get a diploma. No, I didn't need a diploma to do what I'm doing. So
Right. That's a good point. A lot of people don't see that, and they don't compare that to university. I'm spending $80,000 on this degree that just essentially just helped me learn. Right?
Yeah.
Really, I didn't take it. Like, am I doing anything with my finance? Like, Black-Scholes formula on finance. Like, shoot, like, what the heck did I learn, man?
Yeah.
In 4 years of BCom and U of T, like, jack shit. Like, to be honest with you, I didn't learn anything.
No.
Like, in a way, because I'm not using it.
And that's not a knock on education either.
It's not enough. It's not enough.
It's just we're accepting to spend that money on university is totally okay.
It is.
Oh
Yeah.
yeah, you got student debt, you have university education. Somebody says, "Oh, I spent 20 grand to have a really successful business person teach me everything they know." You gave that guy $20,000?
Yeah.
What?
Yeah, I know.
The disconnect is wild.
Yeah,
So,
yeah. But the thing is that they'll help you navigate or mitigate the losses that you didn't see, right? And because you didn't see it, it's like, that's not worth 20 or 30,000. But they steered you away from that big hole that you were going to fall into and break your neck, or this thing that you're going to fall off this cliff and then make you, financially unstable for the next 5 years. That's what you don't see.
Yeah.
But you want them to help you. If you were in that situation, they would say, "Yo, dude, don't step there, don't step there," right? So you got to realize what you're spending your money on, right? You're spending your money on a business that potentially can, earn you quite a bit of money, more than your career.
I love it. For those of you, I don't know I was going to say this. For those of you who don't know, I'm going to do a plug for why you should do social media. And Kasey and I, this is the first time Kasey and I have met.
Yeah.
And we shook hands and we both said, it's like I already know you.
Yeah, I know.
Because we've been posting on social media. We've been following each other for years. So for those of you who are getting into the real estate business, you got to get yourself out there. Kasey talked about, he doesn't, full transparency, Peter does all my social media. The man behind the scenes, he does it all. Kasey talks about, he plugs in his phone, takes a video, posts it. Whatever it is, you got to get on socials, because this is how you make relationships, where you sit down with a guy like Kasey and feel like we've known each other for the last 10 years.
Yeah.
And we have an hour conversation and hopefully provide some really, really good value. With that, I think we should call it a wrap here. I'm definitely going to have you on again. I do want some comments in the section about mentorship. Like, what are investors looking for? What do you need? What aligns with you? Put those comments in.
Yeah.
I think we're both interested in hearing.
Yeah, exactly. Like, what do you got when you guys need something? How much are you willing to pay for it? So we can slot people in. So it could be like, "Oh, I'm willing to spend $20. Okay, fine. We can try to make something work. Oh, if it's $100, what's that? Or 500 to, let's say, 5,000 or 20,000. We can try to. If there's a lot of people in the $100 a month range, and there's like 200 people, we'll slot you guys in, or even 5 people, we'll slot you guys in. Right?
Yep.
That's what we need. It's like, feedback is like, what are you guys looking for? Because honestly, I post stuff and there's like no comments. I'm like, okay, maybe I'm not doing a really good job, right? Like, whatever.
I saw a saying that goes, because it's all about views now, not likes and comments. And it's everybody's watching, nobody likes you.
Yeah.
So it used to be likes and comments, but now it's just views. And I'll tell you, I get people all the time that are like, "Man, I love what you're doing on social media. I watch it all." I said, feel free to throw a like or comment every.
I know.
Like, oh, I just forget. But like, I watch everything. Whenever I see your video, whenever I see it, like.
But we don't know it.
We don't know.
I'm like, okay, maybe I'm not doing a good job because like I'm not hot and sexy, right? Like,
Yeah.
Dude, like I think I have to be like hot and sexy. Like we're a couple of like middle-aged men. How old are you, Kyle?
I'm 35.
Oh, you're 30. Oh, sorry.
So don't quite middle age.
You're not in middle age. You're a young stud. Like, I'm 50 years old. Like, I don't know what the heck. Like, if I'm a hot girl and I put something like a feed where there's a hot, it blows up.
Yeah.
Right? I'm acting like a kid, and
Eat some eye candy on your walk around.
I know. I'm like, but my kids are like, you gotta spruce it up. I'm like, no, dude, like I don't want that. I'm not trying to gain attention just for the sake of gaining attention. I want to add value, but I don't know what to add. So you guys have to let us know comments wise. Like, just let us know.
Love
what. Yeah.
I love it. Thank you so much for your time, Kasey. I hope everyone got a ton of value. Make sure you like, subscribe, comment on this video, and looking forward on having you on the next episode of The Hard Truth. Thanks, Kasey.
Thanks.